Great to see you, Armen.
Great to see you both.
Are you buying right now?
Carefully. We are mindful of the exposure to tariffs. We are mindful about the potential retaliatory tariffs. We think there's some good value out there, especially in public credit. But we are also recognizing the fact that we may be on the precipice of some volatile times ahead.
What are credit spreads telling us right now? We had that brief spike in early April, and I know we're still elevated, but we're nowhere near the types of blowouts we saw during past financial crises.
Correct. We're at about a 360 spread in U.S. high yield. If you look at the high and the low over the last 6 months, it was 260 and 460, so we're right in between. So you have to ask yourself, has the news been supportive of being sort of right in the middle there? I think the second and third quarter numbers as they come out, however, could suggest that 360 is a little bit on the tight side, to be honest with you.
Armen, I guess what we have to do is kind of accept the reality, though, that, all right, here we are at this moment in time, but 24 hours from now, it could be very different based on what's coming out of the White House. So when you say precipice of a volatile time, I mean, that's the reality of it. What would happen to make things settle down? Is it a tariff agreement with U.S.-China? Like, what is it in particular?
I think it's exactly right. If President Trump decides very, very soon that there is a reasonable resolution with China in particular on tariffs, then I think there's a relative calm that will persist in the economy and the markets, and companies will be able to know what to do next. For now, what's happening is there's a delay in spending, consumer spending, capital expenditures. As that continues, it could cascade into unemployment, and that's the sort of the really negative outcome here if this negotiation takes much longer.
All right, so if they get a deal, and it is a little bit more onerous in terms of tariffs between the two nations, is that kind of okay as long as we know the terms, or the terms do matter as well?
The terms do matter because whatever the tariffs are, let's say it's 60% on China and 20 or 30% for the rest of the world, that's still inflationary.
Right.
And so the question is, what's after that? And Secretary Besson mentioned sort of a three-pronged approach. There's tariffs, there's taxes, and deregulation. So the question is, does the deregulation and do the lower taxes offset the impact, the inflationary impact of tariffs for consumers or not? If it doesn't, then there could be demand destruction and some economic issue.
So Bloomberg reported last month that Oaktree was setting up another special situations fund, trying to raise money for that. Are you able to share any thoughts on the progress of that?
Well, we can't talk about any particular fundraise, but we do see a lot of opportunity for companies in need of both equity and debt to help them bridge through uncertain times. We are seeing more activity in terms of companies calling us for rescue loans. I know others have mentioned that as well. I expect that given what's happened with the policy backdrop, and private equity firms had hoped to be able to sell out of their businesses earlier this year. It was supposed to be a really strong year for M&A. But given what's going on now, I think that those same private equity owners will have to come to the likes of Oaktree for some solutions that help to extend their ownership of those businesses.
Has there been discussion, not just at Oaktree, but just amongst your peers as well, in the private capital space about trying to find ways to increase liquidity, or at least have the flexibility to increase liquidity should times really get hard?
In terms of in liquidity in the asset class, I think that's very hard to do.
Yeah.
Now, the reason is in below investment grade credit or unrated credit, the borrowers want their financials to be not in the public domain. You need those financials to be in the public domain to be able to increase liquidity and transparency in the trading of those assets. In investment grade private credit, because usually the borrowers are already publicly traded, it's easy to triangulate to the value of a privately issued credit to a publicly traded company.
What are the geographical variations and differences that you're seeing, or dispersions? Europe has been a topic we've been talking about a lot here at Milken. Talk to us about that, if you would.
Well, we're not seeing a tremendous amount of dispersion yet, but what we are seeing, however, is our clients globally are wondering whether they need to back off on how much exposure they have to the U.S.
They really are asking.
They are asking. They know that the U.S. is still the best place to invest. It's the deepest market, strongest economy. But the question is, has the U.S. damaged itself in some for an intermediate period with some of the policy statements we've made? And if that's the case, should we be should we, a non-US LP in particular, should we be looking at other parts of the world, like Asia or Europe? In Europe in particular, there are some tailwinds, and the tailwinds being stimulus around defense especially, and infrastructure relating to defense. A lot of capital is going to be spent. Debt to GDP in a country like Germany is low enough that there could be some additional debt taken on by Germany to fuel this type of build-out. It's probably a good time to think about asset allocations a bit.
With regards to some of that allocation that we're seeing to Europe, is that concentrated, though, around defense or at least around industries that would be a direct beneficiary of that increase in fiscal spending?
I think it's too early to tell, but I would say it's the point of focus is in general industrials, and that is a first order and second order, or it depends on defense on a first order and second order basis.
Do you think we'll see much more of an opening of the European market to private capital, private credit, private equity? That they didn't necessarily chase the U.S., at least not to the same scale that we have here. Do you see the potential for that market to actually expand?
I see it. I see the potential to expand. I think the size of the borrowers in Europe, however, just tend to be smaller. The market is smaller. I don't see it becoming the size of the U.S., but I do see it growing from its current status. I think the hard part is for European LPs, for European investors, there is a different regulatory dynamic that requires them to really favor European investment, and they're not finding enough to do right now. They have a lot of capital and not enough places to put it in Europe. So the market does need to expand. The question is, will there be enough businesses of size and scale and giving depth to that market for deployment in the region?
Armen, when you said that some of the investors were saying, should we reduce our exposure to the United States, by how much? Are they just saying a little bit, or are they looking to say, do I need to be a little bit more aggressive outside the U.S.?
For now, it's by a little bit.
Okay.
Right now, most non-U.S. investors have something like 50 to maybe as much as 70% of their portfolios deployed in the U.S., private equity, credit, a variety of types. They're not talking about cutting that in half, but 5, 10, 15% could be on the table.
That's pretty significant. Hey, last question. Milken, I feel like from year to year, the mood, the narrative can change. It feels like everybody's here trying to figure out what's next. Yeah, there's always a part of that, but I'm just curious what's striking you about this year's conversations.
It's a good question. I think because the S&P is back to sort of Liberation Day levels, I'm not surprised to hear that some people are probably a little bit more optimistic than that there will be a deal cut. I'm surprised to hear that there's a belief that that sort of rationality or rationalism will prevail and that we'll get to a deal on the tariff side that is acceptable to U.S. companies in a reasonable enough period of time to avoid a bad outcome. Well, I don't think that's off the table. I don't think that that's the likely outcome. And I think that the mood shifts depending on whether you're talking to U.S. investors or non-U.S. investors. U.S. investors are quite U.S.-centric and they believe everything will be fine. Non-U.S. investors are a little bit more concerned because they are, frankly, a little bit more culturally sensitive to what our trading partners now think of us. That's a sobering kind of dichotomy in terms of conversations that I've been having over the last few days with our client base. And it gives me pause. It gives me reason for real concern that we're going to have some troubled times economically, which will then eventually create some opportunities to invest in the markets.